Hi, folks. This is Sean Hyman from The Logical Investor, and I want to talk to you about the fundamentals that I follow and how I determine if a company is a good company or not, how I know that it's solid. I don't have to go off of hunches or gut feels or um, any type of information that anybody else can't pull from. I'm simply can look at things logically, like the newsletter says, and can really size them up. Even if it were a company that I weren't familiar with, I can look at their fundamentals and I can tell you if they're solid or not. And much of it is just the way that I would tell if I were able to look at your own personal finances, and even if I didn't know you, and how much cash you had in reserves would be part of how financially sound you were, and how apt you would be to make it if you were in between jobs or through recessions or handle emergencies, etc. How much debt or how little debt you had relative to your net worth and assets and things of that sort. All that would play into how well you would likely go through the next recession personally, how well you would handle gaps in employment, all kinds of things like that. And so for companies, it's no different. It's just all on a larger scale. And so that's how I size companies up and know if they're big enough, strong enough, deep enough pockets enough to make it through recessions, through slumps in their business cycles, anything like that. I can size companies up. So we're going to go through an example of a good stock and maybe one or two examples of what I consider to be kind of a bad stock fundamentally, and let you see what I'm looking at. So what I do is I go to Yahoo Finance, which to me is one of the easiest to read fundamental sources out there. So Yahoo Finance can be found at finance.yahoo.com. So finance.yahoo.com. And what you'll do is you would put in a ticker symbol here or the name of a company, and it would give you a list of symbols, and you can click on it and click search. And then I click on this page called, this little tab here called statistics. And it's going to give me all the numbers on, or all the most important numbers anyway, on a company. So the one I've pulled up here is Qualcomm, which is symbol QCOM. And this is what I would consider to be a good company. And so let's go through some of the metrics. I just pick about 4, 5, 6 metrics off of the page. I don't have to look at every single thing that's on both these columns. Matter of fact, I don't even worry about this column over here at all. And there's only just a handful of things over here that I size a company up with. So the first one is called market cap. And market cap is just the price per share times how many shares of a stock are outstanding out there. So ultimately, it's just basically, in simple terms, it's the size of the company. How big is the company itself? So Qualcomm is an $82.2 billion company. So that's a massive company. So the thought process being a massive company is likely going to survive a downturn more so than a $200 million or $1 billion company in the same niche, let's say. So massive company, and usually when a company gets massive and huge, it's almost by default they've got massive amount of market share, and many times they'll be a household name in what they do and that sort of thing too. So there's a lot of other side perks that go along with that, but I look for something that has many billions in market cap. Occasionally I might pick a smaller stock, but even then it's got to have at least 1 to 5 billion in market cap, and those will be rare. Most of the ones I pick will be 10 billion to 150 or 200 billion. So 82 billion is a really sizable company. So I know this is a huge company that I'm dealing with, not some little small mom and pop type operation. And so the thought process, think of it this way: if you were going to open up a hardware store, would you want to be the little mom and pop hardware store on the corner, or would you rather be the Home Depot that's on the corner? Picture the ability to go through the next recession. Who's going to last better? I know these extreme examples, but Home Depot likely going to last better, or the little mom and pop corner store, that sells a few saws and hammers and stuff like that, a few nails. It's going to be Home Depot. Why? Because they're massive, they're huge, they got huge brand, they got deep pockets, and they're going to be very, very hard to compete with. And if anybody fails in the recession, it's going to be their smaller competitors And then when the recession's over, if they want to go buy up some of the bits and pieces of their smaller competitors, they can likely do that because the smaller companies will be, nearer at bankrupt and be wanting to liquidate. And then a big company comes out of the recession, possibly even bigger and stronger and with less competition. So that's the power of getting a big company, huge company. So when stocks are gyrating out there and they're moving up and down quite a bit percentage wise, and of course people don't move, they don't really get all caught up in if they move up a lot percentage wise. They only get caught up if they move down a lot percentage wise. But one of the things that gives me a lot of solace, and one of the ways that I sleep very soundly at night, even with any kind of gyrations in my accounts, is that I know that I've bought a diversified portfolio of enormous size companies, and so that helps them tremendously. One of the next things, and I'm not going to go in order here, but one of the next things that I look at after the size of the company is how much do they have in total cash? How deep are their pockets? So Qualcomm has $9.98 billion of cash on their books, so right at $10 billion of cash on their books. Well, there's sometimes you'll pull up balance sheets and you'll look at a stock, and the company may be well known, but they might have 20 million or 200 million dollars in cash on their books. Well, I like to see the B on the end of something that I'm invested in, billions of cash on the books. Why? Because the company that goes through the next downturn, the next recession, the company that's needing to buy a little time to get turned around, get something right, the one that's going to survive is the one that's got the deepest pockets, and the ones that probably aren't going to survive are the ones that don't have near enough cash set aside. So, picture you and your neighbor going through a recession, and let's say, you've got $50,000 in cash in your savings account, and let's say your neighbor has $500 set aside in their savings account, and you both get hit in the recession, and let's say you're both in the same niche and industry, and you both happen to lose your jobs, and it's both some months before you're able to reconnect and find that next new job and get going again. Well, who's likely possibly going to go under or go bankrupt? Is it the guy that has $50,000 in their savings account, or is it the guy that's got $500? Well, it's the guy that's got $500. And so that's the concept of cash on the books. How deep are their pockets? So the deeper the pockets, the more you can weather the storm and the stronger of a company that you are. A lot of people don't place a lot of value in cash, but I promise you there is a lot of defensiveness in having cash position. And so they have a lot of cash on their books, and so therefore I deem them to be a good company. Another thing is, how much debt do you have? So total debt. They've got $11.94 billion in debt. Now, a lot of people may go, oh my gosh, almost $12 billion in debt. Ooh, it's a lot. Remember, debt is relative to the size of the company. So, if they had $12 billion in debt and they were a $15 billion company, that'd be a problem. But when we come back up here, remember, this was an $82 billion company. So with an $82 billion company, just shy of $12 billion in debt is not much at all. So ideally, you want to have a company that has a third or less of its market cap size in debt. And what is still healthy and acceptable is up to 50% of market cap size in debt. So let's just use round numbers. If this is an $80 billion company, then you would want to see them have no more than $40 billion in debt here, and much less is better. Well, they've got very little debt relative to their size. Now, let me say something here about debt. See, some people think all debt equals bad. Debt is bad. And that's because we view it a lot of times from a consumer standpoint. Consumer debt is bad. If I go and take a Visa credit card and I charge my groceries and my gasoline on it, and I buy sweaters and t-shirts and food with it and all this kind of stuff, that's bad because it's consumer debt. That's just I'm racking up debt that it's in depreciable assets, or it's in something that will be consumed and will be no more, yet I'll still have the debt there. Good debt, and believe it or not, there really is such a thing. Read Robert Kiyosaki's books, Rich Dad Poor Dad, Cash Flow Quadrant is even more of a favorite for me than Rich Dad Poor Dad. But so if you can take and utilize some debt to leverage an asset that can go up in value and appreciate rather than depreciate, then you're able to lever and have a greater return than what you would possibly have before. So there is an advantage to that. So let me just back up a little bit. Let's say Qualcomm, for any money they can get their hands on, can invest that into their business and return 30% on that money through making a product or delivering a service and the profits they reap from that. And that's very much doable, especially in a technology company and things like that. And you could argue the percentage, but let's just go with that. Then if they had to go take a loan and get and let's say a loan for 5% or 9% to leverage a little bit of that so that they could go and accentuate their 30% return on borrowed dollars, then they would actually make more money in earnings than if they'd just been totally in cash and zero debt alone. So there is some benefit to having some debt. It just always has to be something that goes into appreciable assets, not depreciable assets. And it has to be small relative to your size as a company. So a third or less, ideally, 50% or less is acceptable. Anything above that, if I look down here and this was 60-70 billion dollars in debt, and it was a $82 billion company, that would be crazy. I wouldn't, you wouldn't touch me. You wouldn't catch me touching that company with a 10-foot pole. So how much cash and how much debt they have and market cap size are huge. Another one I look at is EBITDA. That's a lot of initials. Earnings before interest and taxes, and I believe it's depreciation and amortization. I believe anyway. You can Google that, but it's just a fancy term for saying this is their earnings before all the accountants get to play with it and make it into all kinds of other stuff and do kind of the funny accounting stuff with it. It's just raw earnings. So I like to drill things down into their simplest, plain English terms, and that's really what that is. So when you hear EBITDA, that's what they're saying. Plain raw earnings before it's really basically messed with. So they made $7.88 billion last year. Well, that's significant because, if we go into a next recession, or let's say Qualcomm struggles with trying to, maybe they're kind of missing the market and they're kind of off their game and they're doing poorly for a quarter or two or something like that, and they need to kind of turn things around. Well, if they're making billions of dollars per year, you've bought yourself some time to get things turned around and figured out, versus if you're just if you're a big company and just making a handful of million or something like that, which sounds like a lot to an individual, but to a big company that's nothing. If they wouldn't be if they weren't hardly earning anything, then they would be a weak company. But to earn almost $8 billion, is good to have. Almost $10 billion in cash is good to have. A little less than $12 billion on an $82 billion company is good. So those all tell you whether the company itself is sound as a company or not from a fiscal, financial, fundamental standpoint. Then once you determine whether it is or is not, if you determine it's not, you need to look no further. You don't even have to worry about any other numbers. And keep in mind, I do all this work for you. I do all the homework. I look at all the stocks. I determine what we'll be buying in this newsletter and selling and why and when and all that. So you don't have to know how to do any of this stuff at all whatsoever. I do it all for you. So don't think that you have to have your mind around all this to be a part of this newsletter. You do not. You can be a brand new investor and follow what I'm going to teach you. I'm just trying to teach you the logic behind it, because I want you to not only, I'm going to fish for you, but I want you to know how to fish, and so I'm teaching you the whys behind it and the nuts and bolts behind it in case you want to know. And it also helps you build confidence on, okay, well, Sean's, vetted this company and it's solid, and here's why. Like, he's got facts behind it. not just, somebody around the water cooler said, oh, go buy this stock and we don't know jack about it. We're just going to go out there and buy it. I mean, that's called the emotional investor, not the logical investor. And that's how most people invest, very illogically, very emotionally. So the next thing is, when we find out whether it's solid or not, if we find out that it's a solid company, which we determined this one is, then we go look and see the valuation. And how do you determine from a fundamental standpoint if you're at a fair price or a high price or a low price? Well, one of the chief ways that you can do that, in some companies, non-technology companies, like price to book would matter, and that's the stock price relative to their net assets that they have. But a technology company is not going to have tons of buildings and machinery and things like that, like an industrial plant would or something like that. So price to book doesn't matter as much in a case like this. So, but what will matter quite a bit in every sense, on every company, is their earnings, their trailing PE, which is a price to earnings ratio, and a forward PE, price to earnings ratio. So in the trailing price to earnings ratio, that is looking at the earnings that the company has produced over the last 12 months, according to their fiscal calendar that they're on. So some people will be on a December calendar, and some people may be on an oddball fiscal calendar like April or something or whatever. But in their last fiscal year, this would be the trailing PE, price to earnings ratio, and the forward PE looks at the forecasted 12 months of what they're anticipated to make in earnings, and compares that anticipated earnings to the stock price. And so both are important. This one's already in the books, and this one's looking ahead what's to come. And so you want a price to earnings ratio. Generally speaking, now every stock sector and industry will be different, but generally speaking, stocks that are like a PE of 6 to 12 will be of deep value or value. Stocks that are PE of 15 to 18 are typically fairly valued, and stocks that are above that are typically overvalued. And that's in general. So a technology company with a fast growth rate will can stand a little higher PE than a utility company that's a slow growth rate or maybe almost no growth rate to it. So there are some other variables there. So I'm just talking in generalized terms. But there's a way that we can measure a stock price versus its earnings, because that's the whole reason why a stock should go up over time, is that its earnings power goes up over time. So, if I own a local pizza shop and, this year I can turn out $100,000 in earnings, but 10 years from now, let's say I can turn out, $10 million in earnings, maybe because I've multiplied my stores and, beefed up marketing and advertising or what have you. Well, that would command a lot higher price that I could fetch for that if I were to sell it, because of the earnings power of the company. So that's one of the best things that you can look at, is the stock price relative to its earnings. A lot of people would just look at a stock price per share and they'll go, oh, it's $5 per share, it's cheap, let's buy it. Well, you could have an astronomically high PE with a stock that's $5 a share, and then you might have, on the other hand, a stock that trades at $150 a share, so it's expensive on a price per share basis, but it might be a forward PE of 8 or something like that, and be an extreme value. So price per share is a poor measurement of whether something is a value or not. But comparing the stock's price relative to its earnings and getting that ratio, that PE ratio, that is a better way of looking at it. And so its trailing PE was 18.54, which again wasn't too bad, but the forward PE is 14.30. So that's good. And particularly at the time of this filming, the S&P 500 has a trailing PE of around 24 to 26. So it's definitely cheap relative to the overall market. And a PE of 14 is cheap for a growth technology company going forward as well. So the former metrics, market cap, cash, debt, earnings, things like that, tells us whether it's solid and sizable or not. And then the PEs tell us whether that sizable solid company is at a good price or not, because you can buy a good asset at the wrong time. So, for instance, houses were great to own, but if you owned them in 2006 and 2007, if that's when you were buying, you were kind of buying towards the top of the market. Mid 2007, 2008 were really, really rough to you. Yet it was still the same bricks and mortar, still the same quality of neighborhood that it was a year, 2 or 3 earlier, and so forth. So the quality of the asset, quality of the neighborhood, the school systems would have been about the same, etc. So that all would have been apples to apples, but the price you would have paid for that house was far different in 2007 than what it was in 2003, let's say, because housing had gotten out of hand with people buying and flipping houses and doing all kinds of crazy stuff. So you can buy a good asset at the wrong time and the wrong price, and looking at the PE ratios, it helps you to determine not only is something a good asset by looking at the other metrics, but also is it a better time to be buying it by looking at the PE ratios. Now remember, I've already done videos on sentiment and technical analysis as well, and that will help you with the timing of a good asset. But one of the first things you want to look at is it a good time to buy from a PE standpoint once you determine that's a good solid asset. And then if it is, then go to the charts and look and see what you see from there. So the fundamentals are always the most important thing, and then technicals and sentiment trail after that in importance. Why is that? Well, the fundamentals tell me how solid a company is. So, if I just see a stock going up and a recession hits, I'm not going to have confidence in that stock if I don't know how solid it is. But if I know how solid the company is, it can be bobbing up and down and doing all kinds of crazy stuff on the charts, and I'll still have confidence and conviction in that stock because of how solid it is. So, for instance, so for a short period of time, I used to live in Miami, and I would take trips down into the Florida Keys, and I used to love going down to the Florida Keys and looking at some of the houses that were right near the edge of the ocean. And I mean, these houses were huge, multi-million-dollar houses, and the walls were just built super thick. And why were they built super thick? Because hurricanes routinely came through there. I mean, every so many years, you were going to usually have a bad one come through there. So if that house wasn't built rock solid and with super thick walls and all kinds of reinforcement and this, that, and the other, when the hurricane comes through with 150, 200 mile an hour winds, that thing ain't going to be standing. That's going to be a multi-million-dollar pile of rubble. So, that's the equivalent of a fortress of a company. When it goes through the winds and the storms of a recession, will it be standing when it's all said and done? Well, market cap, cash, debt, all these types of metrics, earnings, can size that up for you and tell you that. You don't have to guess and wonder about it and turn on the TV and find out 10 people's opinion about it. You can just simply go to something like this and look and know that you know for yourself how solid something is. So that's the power of fundamentals. And there's other stuff on the summary page that I look at as well, such as the dividend yield. Like this happens to have a dividend yield of 4.12%. That's amazing. A lot of companies don't have that, etc. But 90% of the information that I look at is just a handful of things on the statistics page for on Yahoo Finance. Okay. So so I took a lot of time explaining those and showing you a good company. Now let's go look at something that is not so good. So Snapchat's a popular stock right now, but it's not such a good company. And it's one reason why I wrote articles against discouraging ownership in Snapchat. And Snapchat just traded, as of this reporting, below its IPO price. So people, even that bought in the early stages of Snapchat, are now even losing money. Well, okay, so market cap $20 billion. Okay, that's not a bad size there. But it earns no money, and that's why there's no there's no earnings to compare it to, so that's why these numbers are negative. So the trailing PE is negative, and the forward PE, so the forward projected earnings are even worse, in the negative, and so they're expected to be even worse off from an earnings standpoint, even going forward. So that's horrible. So would you rather own a company that makes money or a company that doesn't make money? And then of course there's other metrics that you can look at as well, like profit margin. They got zero profit margin. So when you go through the next recession, you're gonna have confidence in a company that doesn't make any money, has zero profit margin, just because they got a cool, sexy little app out there? Probably not. Um, so they're losing money. Lost $2.59 billion over this past year. So they're bleeding money pretty good. That didn't give me a lot of confidence. And again, their debt's not too bad, 15 million versus a $20 billion company. Of course, that 20 billion is an overpriced market cap, in my opinion. And they've got 3.24 billion in cash on their books. But if you're bleeding to the tune of 2.59 billion dollars last year, that ain't that much cash for somebody bleeding. That's a big hole in the side of the ship, So and that's hard to plug. And this amount of money and plugging that hole all that easy. So they've got to do something different. They're going to have to, figure out something, get the earnings turned around, raise some more capital, something to keep the ship afloat. So so that's an example of a bad company, in my opinion, from a fundamental standpoint, and why I would not want to be caught dead in that stock, no matter what kind of cool little app they've got or whatever. So just because something seems cool and sexy doesn't mean it should be investable. If you like the app, use the app, but it doesn't mean you should buy the stock. So back in the day when Tesla's fundamentals were so weak, I would say if you like Tesla, go buy the car, don't buy the stock. And there's some companies that are fundamentally sound, but I don't, particularly personally in personal taste, like their products. I would own their stock, but not their product. So. But just because somebody's got a cool product or a sexy product, or whether you do like or don't like their product, has really no bearing on whether you should buy their stock or not. But everything you need to know is going to be on a page like this and tell you from a fundamental standpoint whether something is solid or not. If it meets the sniff test, so to speak, fundamentally, and everything's all a go there, then that's where you can go over to the charts and start, nitpicking better places to buy and better places to one day sell and all that kind of stuff. But if it doesn't meet the test of it being a solid fundamental company, you don't need to look at any charts or anything else, because you're not going to have any confidence in that company. So every little dip that it has, every little ripple on the chart, you're going to be getting in a tizzy about, in an emotional uproar, and you're going to be second guessing yourself and all that, because you have no confidence in the quality of the company, because you only see it as a stock that's trading on a chart rather than an actual company that exists that produces goods or services to a consumer base, and so, or consumers or businesses. So the fundamentals will tell you that, and that's I know I took a little while here, but I wanted to tell you in plain English why those different metrics mattered, and the reality of why they mattered, and then take a look at an example of, again, at the time of this filming anyway, one that was solid and one that was not. So thanks so much for watching, and God bless.